Good evening to all our esteemed participants of this one more webinar organized by the GST and Indirect Taxes Committee for the benefit of each and every one of you. I deem it a great pleasure and privilege to welcome each and every one of you to this webinar organized by our committee. And as all of you are aware, the week with sessions. Here with us on the screen, if we can see, a very eminent chartered accountant from Chennai and a person who is deeply involved in the practice of GST. Sharda is known for her very big reach in the social media, especially on Instagram, where she runs a series by name Sharda GST in Shorts. Esteemed friends, today's topic is very interesting. In fact, 2 hours is not sufficient to cover a sector which has always been in the limelight for any authority or including practitioners or even those who do that business, the real estate sector. In fact, we would like to run series of webinars on especially real estate and construction industry going forward. This particular sector has always given sleepless nights to everyone who has dealt with it. It has made millions. It has also sometimes brought down castles. Esteemed friends, this particular topic today that we have, the consumption taxes on the real estate sector, we have a very eminent chartered accountant, Sharda. She's been in practice for more than a decade now. She has been a regular faculty for the GST and Indirect Taxes Committee. She is one person who is readily available for the committee and its work. Faculty for the certificate courses, for the seminars, for the webcast, and also for our publications. Sharda is known for her erudition and she is known for her clarity in thought. I welcome her and thank her for offering her time to this particular webcast organized by us. I also recognize the presence of C.S. Smita Mishra, the very efficient and energetic secretary of our committee, and ever enthusiastic and energetic and agile Impreet Kaur, a person who regularly engages in these type of programs. We also recognize the technical support offered by the Institute's authorities, and I thank them also. Esteemed friends, without wasting much time, I welcome C.A. Sharda Hariharan to please make her presentation to all of you. Thank you very much. Over to you, Sharda.
Thank you very much, sir, for such a very warm introduction. And, for many of us speakers, it's the profile that we had to hear, which, we know by ourselves. And it's really such a warm message when you don't actually read through a profile, but rather you actually share it from your heart, right? So thank you so much, sir, for such a lovely introduction. And special thanks to IDTC Chairman and Vice Chairman RK sir to having me here for this session and having trusted me that I'll be able to do justice in this 2 hours for such a complicated topic. And special thanks to all our other committee members, Impreet, Smita ma'am. I think, they all have been really supportive for each and making sure that every single nuances are being taken care. And straightly, as RK sir rightly pointed out, 2 hours is definitely not a sufficient time if we have to talk about real estate, because it's such a not only a vast topic, but also a very deep topic by itself. So without, wasting much of time, we'll directly get into the topic. Now, before I share my, presentation, I want to just give you a bit of different perspective on this real estate and the importance of why this is so much spoken about, as compared to any other sector or any other topic in GST, why this industry has been so much spoken about, right? So let's look at it from a very, very high level, macro level perspective. We all know the fundamentals, direct tax and indirect tax. I know there are a lot of professionals here, but I also acknowledge that there could be a lot of students or budding professionals as well. So for them to give a very macro level perspective, I'm trying to give this, 1 or 2 minutes of my thought. So we all know the fundamental difference between, direct tax and indirect taxation. Now, coming to this indirect taxation, one thing that we have to always recognize is that both direct tax and indirect taxes are ultimately on the citizens of the nation, which means whatever is my income, on that, if I have to pay the tax, it means it is income tax. Whatever is my expenditure or savings, on that, if I have to pay the tax, it is the indirect taxation. It's just that it is being indirectly collected by all these businessmen whom we call it. So this is a very, very, very layman's perspective of understanding this indirect taxation. Now, with that understanding, let us say a simple example. I go to a restaurant and I have a bill for 1,000 rupees. On that, 5% GST is being charged and it's 50 rupees. Do I really bother so much for that 50 rupees? Probably the answer is no, right? I know that with this 1,000 rupees, there is also a 50 rupees. I'm not talking about the composition scheme and other things. Let's keep it as simple as that, 5 percentage. Now, the same thing, if I have to purchase a property with all my hard-earned savings, and I need to purchase a property for 1 crore. 1 crore today is nothing in the metropolitan cities, right? So for 1 crore, you will hardly get a one-bedroom apartment. That's as simple as that. So even to get a simple, small 1 BHK apartment in metropolitan city, and you need to literally save so much of money, as much as 1 crore, and then you go and invest on it. Somebody says you also have to pay GST at the rate of 5%. GST at the rate of 5% on 1 crore. How much is that? 5 lakhs. Do you think 5 lakhs is going to be a very small money? Obviously, the answer is no. So the one fundamental reason, so let's understand the root cause of this whole fuss about this real estate is that now these real estate developers, these business owners have the challenge of collecting this tax from the consumers, and for them, for just a property costing 1 crore, which is out of their hard-earned savings, it's the 5 lakhs of money which they need to separately shell it out, and they need to separately pay it in the form of tax. So this is exactly where the developers have the difficulty of levying and collecting taxes. So naturally, when the levy and collection becomes difficult, the entire taxation gets strained. And quite naturally, we all know some of the advertisements which were there in the early stage of GST law implementation, like, no GST if you purchase. So there is no concept of no GST. It's just that after completion, if there is a GST, that property has already suffered GST, which means there is no separate collection of GST. So if you were to look at it from your purchasing point of view, this very simple thing is, do not worry about what is stamp duty, what is GST, what is your construction cost. Ultimately, look into it this way: what is your final price for the property if you were to be a buyer, right? So from the buyer's perspective, whatever tax, it doesn't really matter. Now, coming from the perspective of the promoter. Now, promoter is where, the responsibility on the promoter is literally huge. And if we have to talk about GST law, there is a separate law which has been carved out for real estate as compared to any other industry. Now, why am I saying there is a separate law by itself? For all other industry, they need to follow what is the GST law. But for the real estate industry, they should also follow the GST law, which means, all the provisions of the GST law is applicable just like any other industry. And apart from that, they also have a separate set of provision which is applicable exclusively for the real estate alone. Now, the list of responsibilities that is there on the promoter is literally huge as compared to the previous regime. And again, when we talk about the transition provision, right? So for all the other business, there is only one transition from previous regime to GST regime with effect from 1st July 2017. But when you talk about real estate, there are two levels of transition with effect from 1st July 2017, wherein instead of VAT and service tax, they have been introduced with GST law. And then again, with effect from 1st April 2019, the entire law, the entire framework of the taxation has been completely changed for the real estate as compared to how it was until 31st March 2019, right? Now, in this particular deliberation, let me give you a framework. We will slightly touch upon the transition provision and slightly touch upon the provisions of how it was in the previous regime. We will try to focus more and more on how the law is as we stand today, because it has been 5 years since the transition has happened. It was with effect from 1st April 2019, and we are already in May 2024. So it has been 5 years since the transition has happened. So ideally, it is better that we give all our focus more on the existing set of provision and a slight tinge of transition provisions. Now, directly getting into my presentation for the day. So, hope my slide is clearly visible for you all. Yes, thank you. Now, real estate, the topic is about REP and RREP. Now, having said that, we cannot be construing ourselves exclusively to REP and RREP, because unless we get a framework of how the taxation works entirely in the real estate, it gets little difficult for us to understand only the standalone provisions. So, with that in the mind, so this is going to be the flow of today's deliberation. Fundamentals, what are all the basic legal provisions as we start with the constitutional reference, what are all the key definitions under the GST law, scope of supply, very, very important, because sometimes it's very important to go back to the fundamentals, because as you travel with complicated questions, one thing that I have always realized in all my years of learning is that as you travel along more and more complicated questions in the tax litigation, it is the answer always lies in the fundamentals. So the fundamentals give you an altogether different perspective as you travel into the complicated matters. So with that intention, we are actually going to go back and revisit on the fundamental scope of supply, schedule references, transition provision, as I said, a slight understanding of it, and then the taxability with effect from 1st April 2019, how the taxability works for the real estate projects, notification 3 bar 2019, REP, RREP, affordable, not affordable, residential, commercial, transition for the ongoing projects, joint development agreement. So this is something which is going to be obviously, something that we'll be looking for. So the joint development and the taxability of these kind of transactions, including the TDR, RCM, and then the landowner's tax share of portion, how the taxation works, ITC eligibility, multiple GST responsibilities which is there on the promoter, and certain other complications, including the valuation, time of supply, and some of the common issues and the case decisions that we have to be aware of if we were to approach into a litigation perspective, right? Now, with this background, first let's understand the fundamentals clearly. Now, scope of supply and how the constitutional framework is. If one have to really understand how the law has evolved, a tax law has evolved in terms of the works contract, or, obviously, when we talk about real estate, I would say is a child of the works contract, right? So, works contract, if we have to understand the fundamentals, we have to actually go back to Gurley decision. Now, that has probably set the framework for the entire works contract. With that, the current article, which is actually having the power to levy tax, is Article 366(29)(a). Under the tax on sale or purchase of goods, Clause B talks about a tax on the transfer of property in goods, whether as goods or in some other form involved in execution of a works contract. So the works contract actually derives the power from the Constitution to levy tax on works contract under this Clause B. Now, apart from that, one important fundamental aspect that we have to be aware is when we talk about immovable property, whether you call it as land or the constructed building, right? Because you obviously have to use the word constructed building, because a very simple question that I was, posed by my child is that you call it as building, and then you also teach them the grammar, and then they understand that building is always something that is under construction. No, so the building is constructed building is considered as an immovable property. So these are some of the fundamentals that we have to be aware of. The other important provision that we should also be knowing is the tax on the transfer of right to use. So the tax on the transfer of right to use. Now, having said that, can you say that land is a goods, though there is a transfer on the right to use? The question still remains open. Now, with this, from the Constitution, drawing powers from the Constitution on these lines, the law has been framed to define what is works contract. Now, works contract and construction are completely two different concepts. The difference lies here. Works contract means a contract for building, construction, whatever it is, of an immovable property, wherein transfer of property in goods, whether as goods or in some other form, is involved in the execution of such contract. Now, this is what is works contract. We have to understand from a layman's perspective, we can probably say that works contract is something that involves a composition of both goods and services. But if we have to be very specifically understanding it from the perspective of GST, works contract is defined to only define for immobile property. Let us say, for example, you do a lot of movable structures wherein both goods and services elements are being involved. Probably for the colloquial understanding, one can also call it as a works contract. But when it comes to the GST law, works contract only refers to immobile property construction, the contract for immobile property. Now, the next important provision that we need to be aware of is the Schedule 2, Schedule 1, 2, 3. Most of you will be aware of. Schedule 1 talks about deemed supply, that is, supply even when there is no consideration. Schedule 2 talks about a specific clarification or a specific direction towards what is categorized as goods and what is categorized as services, because one of the major purpose of introducing GST law is to do away with the disputes around what is goods and what is services. Now, having said that, there are still some of these transactions wherein there were gray areas to understand whether you have to define it as goods or services. To clarify or to come out of those kind of disputes, because works contract always has this litigation, whether you call it as goods or services. What is the test of dominance, and is it based on the value or is it based on the value addition? So all these kind of disputes have been put to rest by clearly giving a direction that works contract is a composite supply of services. It cannot call works contract as goods, irrespective of the component of goods which is involved in a works contract. So, end of the day, works contract is only denoting to is a composite supply of services. So, this is something that we have to be aware of. The next important provision in Schedule 2 that we have to be aware of is the construction to be treated as a supply of services. Just like our works contract has been specifically categorized as services, construction is also being specifically categorized as services. Now, supply of services, construction of a complex building, civil structure, or a part thereof, including complex or building intended for sale. I repeat, intended for sale. So it's a very, very, very important terminology. I will come to it in a while to help you understand why is it so important. Intended for sale to a buyer, wholly or partly, except where the entire consideration has been received after the issuance of the completion certificate or first occupancy, whichever is earlier. So the transaction, that is a construction transaction, is treated as supply of services, for which there are two important criteria. That is, one is the service should be delivered before completion certificate or before first occupancy. Why? Which means whenever the completion certificate or the first occupancy, whichever is earliest, has happened, it means it is no more a construction service, it is a completely built property, and hence it takes the color of an immobile property, which is completely outside GST. So this is a very, very important provision that we have to be aware of. The second important thing which I told you, which I insisted upon, is the intention to sell. Now I'll give you a very simple example. So there is a landowner. That landowner has developed an apartment, and that apartment has got, let's say, 100 apartments, right? So 100 flats in that one building structure. So it's a vacant land on which he has invested the money, and he has brought a person to do the construction, and the builder has built a beautiful structure, and that structure contains 100 apartments. Now, very importantly, this landowner is not going to sell even one out of those 100 properties, which means what? There is no intention to sell. Now, despite the fact that there are 100 properties, there are 100 apartments in that one property, this cannot be covered under construction. Rather, it is only getting covered under a works contract. This is not covered under construction because there is no intention to sell. Is it possible? Yes, quite possible. We have also come across such kind of transaction because the landlord may not want to sell it because it's an ancestral property. Rather, they would have developed the property, they would have built the apartment, and then they are going to give it for residential rental purpose. Quite possible. It's for leasing purpose. Now, the same example, let us say the builder, that is the promoter, is also involved. And then instead of me spending my money for the construction, I am the landlord. Instead of me spending some money for the construction, I rather give some properties allotted to the promoter, or what you call as a builder. You cannot technically call him as a promoter, you can call him as a builder. Now, to the builder, instead of paying him money towards the construction, I give him some of the properties. Now, in this case also, remember here, do you call it as an intention for sale? So now this is beautifully, it has to be understood that from the landlord's perspective, there is no intention to sell except for the apartment which is given to the builder. Now, from the builder's perspective also, there is no intention to sell because it's only a construction activity that he is carrying out on the landlord's own land. Now, there is no buyer who is involved. There is no external buyer who is involved. So, it's a merely an agreement between these two parties to construct a property. And then the property is, there is no intention to sell from the property, and that is being retained for whatever be the purpose. Now, these kind of transactions, very important that we need to understand that it will not get covered under real estate, right? So, it will not get covered under real estate. Rather, it is only being covered under the works contract transaction. Now, what is the striking difference between this works contract and construction? The main thing is only when you go under this construction, you call it as real estate, and then this RERA comes into the picture, and then this REP, RREP, 5%, 1%, the entire the whole drama comes into the picture only if it is construction. If it is works contract, it's a very simple, straightforward case of a construction, that is the works contract services, wherein 18% GST has to be charged on the construction services, on the works contract, the supply of goods and services together bundled as a composite supply, on that 18% has to be charged. Most likely the rate of tax would be 18%, right? So the key important variation between these two is there an intention to sell? If there is an intention to sell, if the answer is yes, only then it is a construction, which is commonly called as real estate. If there is no intention to sell, it is works contract, composite supply of services, usually taxed at 18%. Now, if you call it as a construction services, that is, if you call it as a real estate transaction, then the question is it whether the entire consideration is received after completion certificate or first occupancy, whichever is earlier. In that case also, this transaction, in that case, the entire construction services is outside GST. I'll give you a very simple example. Here, the landlord is actually developing the property and built 100 apartments. Now, after completing the 100 apartment building, let us say the first occupancy has happened or the completion certificate has been obtained. Now, after that, if the properties are sold, let's say whether you sell one property or you sell the entire 100 property or you sell 20 property, doesn't really matter. These sales, a sale of immovable property is completely outside GST. Only in a case where the entire consideration is after completion certificate. Now, very important thing, which is a very common question, is that for one apartment, there is a portion of the consideration which has been received before completion, and there is a portion of the consideration which has been received after completion. Now, should I make it taxable for the prior, that is for the consideration which has been received before completion, whether that alone stands taxable, whether the later portion does not get taxable? No, it doesn't work that way. Once a particular apartment is taxable, that apartment is completely taxable, which means what? If the booking happens before GST, then if the booking happens before completion certificate, then that is taxable under GST. So even the consideration which has been received, the remaining portion of the consideration, whichever is received after CC or after first occupancy, that is also clearly taxable under GST. Now, with that understanding, if you go back, where there is a construction and it is a real estate, but the intention is to sell. But the entire sale happens, that means even the booking advance, everything has been obtained only after the first occupancy or completion certificate. In that case, yes, it is a construction service. You cannot call it as works contract. It is a construction services, but it is outside GST, which means what, the entire transaction would have suffered the stamp duty. There is a transfer of the entire immovable property as land and building together, right? Now, the next portion is any part of the consideration, if it is received before the completion certificate or first occupancy, then the particular apartment is entirely taxable. The particular apartment is entirely taxable, right? And then you have to determine whether it is REP or RREP affordable. So we'll come to it, right? So this is the broad level understanding. So we are actually drilling down from macro to micro. It's very important to drill down from macro to micro. So the next important portion of this schedule to which we have to understand is construction to be treated as services, wherein they also give that explanation clause for who is a competent authority. See, I'll also give you a practical understanding, because a competent authority most often, except for in some of the corporates or corporations or cities, the competent authority itself may not be there, right? So the authority may not be there. Then what do you do if there is no such specific authority? Then you have to get a certificate from any of the three persons, that is the architect or chartered engineer or the licensed surveyor. So that is going to establish what is a completion, what is the completion certificate. And then the next important thing is the expression construction includes addition, alteration, replacement, and remodeling of any existing civil structure. Which means what? Even those are getting covered under the construction as a service. Completion certificate and first occupancy, some of the practical perspective, as I told you, completion certificate not applicable when RERA is not applicable. So there is a project, RERA is not applicable for all the projects. Only when there are more than eight or more apartments, RERA will be applicable. So less than 8, there is no RERA. The RERA itself is not being applicable, and hence naturally there is no completion certificate. Then in such cases, first occupancy can be established. Now, how do you establish the first occupancy? Usually, it will differ from state to state. Not every state. Some of the aspects we may not be able to touch upon, like stamp duty or how the first occupancy gets established, because these are completely unique for every state. So, since in this session we have people from various states, we will not be touching upon those kind of stamp duty related matters. Now, coming to this first occupancy, there are some of the common ways in which it can be established. One is the electricity connection, or the electricity no objection certificate, or the conversion from commercial to residential, probably however way the building was previously. So there is a conversion. And then the water connection, drainage connection, documents from municipality, corporation, panchayat. So these are some of the documents through which, see, basically you're trying to establish that this property is now that the construction activity has got completed, and then it is fit for occupancy, or rather the actual occupancy takes place. So that is when the building stops to be called as something under construction, rather it is a completely constructed building. So at that point of time, it is a completely immovable property, which is completely outside GST. If it is outside GST, no levy of GST. Now, that is exactly what we are going to look into in Schedule 3. Schedule 3, sale of land and completed building. These two are outside the scope of GST. Now, very carefully, if you read this particular clause, it says sale of land and comma. There is a comma. That comma is very, very important to understand, right? So, sale of land and sale of building. No, it doesn't work that way. Sale of land, comma, subject to Clause B of para 5 of Schedule 2, which is what we saw a while ago. So this is exactly what is this para 5 clause B. That is the construction wherever it is considered as supply of services. So subject to this, which means whether you call it as whether you actually construe it as supply of services, in those cases it is actually a supply of services. So subject to this particular para, whenever there is a sale of building, which is a completely constructed building. Now, how do you call it as a completely constructed building? It's when the first occupancy or the completion certificate has happened, whichever is earlier. So, subject to this, sale of building and sale of land. Sale of land, there is no subjective element. Sale of land is always an immovable property. You cannot dispute whether land is movable or immovable. So, quite naturally, Sale of land and sale of building. These two are completely outside the scope of GST, which is neither goods nor supply of services. So this is what I told you. Sale of land, comma, the comma makes a lot of difference. So to understand sale of land or plot of land, see, plot of land is also very, very important. In fact, there was a circular 177, because there were a lot of confusions around whether you call the developed plot of land, whether it continues to be land or not. So probably one may think that it is not a logical dispute, but having said that, there were disputes. So in order to put a rest to those kind of disputes, board has already issued a circular 177 has been issued, wherein it has been very clearly clarified that whether you sell the land as it is, or you develop the land, because developing involves a lot of activity. It's not something as simple as that, right? So you have to level the land, you need to clear up whatever that is required. Probably you need to demarcate, you need to get all the local authority permission. So probably it may also require some kind of, laying common roads for access towards those plots. So plot sales is also an altogether separate, set of business. Now, having said that, whether it is sale of plot or sale of land, however way you do it, doesn't really matter. Whether it is without development or with development, however way it is, it's completely outside GST. Now, sale of land, again, you call it as UDS along with completed building. Completed building is also outside GST. If it is under development, if it is during the course of development, sale of land along with construction of building, which is during the course of development or during the course of construction of the building, then it is called as construction or a real estate, and then GST is applicable on construction of building. But here, the important thing is land value gets excluded by way of a deeming fiction of 1/3 value of the entire property. So basically, there is a sale of land and building together. So that when I say land, there is a UDS component. The undivided share of the land is also being sold to the buyer. So keeping aside the actual land value, the notification says that the land value shall be excluded by way of reducing 1/3 of the value, which means, let us say, for example, the property is being sold for 1.5 crore. 1.5 crore is for which a particular apartment is being sold. Probably there could be an X element of land and there could be a Y element of building. Doesn't really matter. The law assumes that 1/3 of this value, which means 50 lakhs out of the 1.5 crore, is being assumed as towards, it is assumed to be towards land. So the remaining 1 crore of the building value is being taxed in GST. Now, moving on, transition provision for works contract. This is transition from the previous regime, that is service tax or VAT regime, to GST era. And there is also another transition that is up to 31st March 2019 and with effect from 1st April 2019, right? So this particular transition which I'm talking about is from the previous regime, that is from the service tax or VAT regime to GST law. Now, the specific provision which is applicable exclusively for works contract, right? Now, you call it as construction services or real estate, all these differentiations are only in GST. Now, you go to the previous era, it is only the works contract. Now, for this works contract, there was a specific transition provision. Some are aware of it, many are not probably aware of it. The provision says that whatever tax that you have paid under the VAT or service tax, whatever be the tax that you have already paid, that tax is eligible to be transitioned into GST law as input tax credit. See, you're not transitioning the balance credit. I'm talking about the tax which has been paid. So let us say there is a property and that property has been developed and that got booked also in the pre-GST regime. Now, pre-GST regime, let us say you have got the property is about 2.5 crore, out of which 1 crore is received before GST and remaining 1.5 crore is after GST, right? Now, whenever I say GST, the cutoff date is 1st July 2017. Now, what this transition provision says is that you would have already paid the VAT and the service tax on that 1 crore, correct? So there is a abatement, all these calculations are there. Now, whatever tax that you have actually paid, that output tax, like how you call it as in GST, the tax that has been paid, that tax has to be taken as a transitional credit into GST, and then you pay tax in GST for the entire 2.5 crore. See, let me repeat the example. 1 crore received pre-GST, 1.5 crore after GST, right? Now, can I pay tax under GST only on this 1.5 crore? The answer is no. What the law says is that Even for that on which you have paid tax in the service tax or VAT regime, once again you pay the tax in GST regime. For that 1 crore also you once again pay the tax. But for that, what am I doing? What benefit am I giving you? Whatever you already paid in service tax or VAT, that amount of tax what you have paid, that you take it as input tax credit. That is, rather you take it as transitional credit. You can take it as a transitional credit under GST law, right? So many might have done this, some may not have done this proper transition. So already there was a reopening of the transition provision that has happened during 2022 pursuant to the Supreme Court decision in the case of Philco Trade Center. Now, some of those builders or promoters, whomever has missed the bus in the to do the proper transition at that point of time, they would have probably, many have actually done this, because this is not only for those who have the technical glitch, not having technical glitch. That doesn't really matter for everybody. One more time, they have reopened the transition credit, and during the time, whomever has missed it out, they have probably done the rectification as well. Now, suppose you have missed that also. See, some of the views that I'll be giving as part of this particular session, especially on the litigative views, I would like to also very particularly insist that you cannot construe it as a view of the institute, right? So these are all the view of me as an individual professional. This is probably some food for thought, which you may or may not take, do your own kind of judgment, assessment, homework to see how that can be litigated. But that's only for a food of thought, right? Now, let us say somebody has missed to transition. How do I litigate? What do I do? There is one way in which it can be litigated, because there are some gaps in the way in which the law has been framed. Now, this 142 is a provision which is only for transition of the credit from the previous regime to the erstwhile regime. It need not be a credit in the previous regime, but ultimately transition of the credit, the purpose is more similar to section 174 under savings and repeals. Now, whether this 142 can also be a charging provision. See, you say you transition the credit from whatever tax that you have paid in service tax or VAT, that tax you take it as a credit in GST. Fine. Now that's fine. I missed to do it. That's a different concept. But whatever money, whatever consideration that I have already received in the VAT or service tax regime, can the GST law levy a tax on that transaction? Now, first and foremost thing, GST law has been implemented only with effect from 1st July 2017. Now, this particular transaction, where not only the execution or not only the particular execution of the agreement, but also the consideration involved has also happened in the pre-GST regime. Now, whatever is the consideration that has been received in the pre-GST regime and that has also suffered a tax in the pre-GST regime, can it be taxed under the GST regime? And whether that can be made through 142, which is a provision which has power only for transition provision. So these are some of the ways in which these kind of matters can be litigated. Now, moving on to the current, as we stand today, how the real estate transactions are to be taxed. So this is going to be the very core area of today's session, which is taxability on real estate construction services, whether you call it as REP, RREP, residential, commercial. So these are the things that we are going to understand next. Now, if we have to get into it, one thing that we have to understand is the real estate is probably affected with, lot of transitions. As I said, see, earlier there was, the works contract itself has a lot of disputes, and then they settled down the law saying, okay, fine, we do some kind of segregation. VAT you pay this much, and then service tax you pay this much. And then they introduced GST law in 2017. Now, prior to that, what has happened? 2016, this real estate has been regulated. I carefully use the word, has been regulated through this act called RERA, right? Now, this RERA is a very, very landmark shift in how the real estate has happened before and after. If you in fact go back to how that has been the law, the RERA has been introduced in the parliament, the minister in fact very specifically told that there are some black sheeps in this particular industry. Though they acknowledge that there are a lot of professional and ethical businessmen, they also say that there are some black sheep. There are a lot of issues which were there. Very honestly, there were a lot of issues because there are cancellations and then the money was not being returned, and then there were a lot of delays in the projects. There were a lot of handing over delays.
So ultimately, it is the consumers which were actually, the consumers were being hugely affected because of some of the not so regulated, unorganized players in this particular real estate market. So, in order to regulate this and in order to bring a lot of transparency, as we stand today, I think definitely by and large, this particular sector has, got into a better professional and transparent way of functioning because RERA has an enormous list of compliances that needs to be done. Now, having said that, definitely RERA is a welcoming regulation in terms of protecting the consumer's interest. But having said that, this also creates a huge responsibility on the promoter. Promoter meaning builder or developer. This creates a huge responsibility on them because it's not that easy to get the RERA approval, and you need to also comply with a lot of compliances before getting registration under RERA as well as after you get the registration under RERA, right? No, but that definitely brings a lot of transparency in the way in which this particular segment works. Now, in fact, one of the key provision, if you see in RERA, is that this RERA overrides all the other law in India. In fact, to that extent, they have enforced this particular regulation. Now, coming to this particular very important notification 3/2019, which has been made with effect from 1st April 2019, if you see, many of the definitions have been borrowed from RERA. Most of the definitions have been borrowed from RERA. Very important definitions. Now, how does it, how is it making a difference? If you read the notification does not copy paste the definition. The notification gives a reference to the definition, which means what? Let us say, for example, apartment. If you read the notification 3/2019, the notification says apartment is as how it is being defined in section 2, subsection E of RERA. So, which means what? Whenever the RERA is going to undergo any kind of amendment, so quite naturally, those amendments are also going to be applicable under the GST law because there is a cross referencing to the other law, right? So it's not a copy paste, rather it's a direct referencing. So it is, we are all as much as we have to be updated with the GST law related changes, one should also be updated with any change if at all that has to happen under RERA as well, right? Now, coming back in my presentation, there are some of these definitions which I have highlighted in orange, which indicates they are the borrowed definitions from RERA. I would not say rather borrowed. Instead, I have to use the word which has been referred to, which has been pointed towards the RERA, right? Now, apartment is one very specific definition. Now, the next beauty, if you see, it's not that all the definitions are being referred to RERA. Some of the definitions are being referred to RERA, some of the fundamentals, and then they also develop upon it in notification 3/2019, which means RERA only talks about apartment. And then this particular notification 3/2019 further develops into what is residential apartment and what is commercial, right? So there are some of the definitions are borrowed, some of the definitions are being inbuilt in notification 3/2019. Now, what is an apartment? Apartment covers literally everything, whether you call it as block, chamber, dwelling unit, flat, office. Remember, even flat, office, showroom, shop, which means commercial, residential, everything is included under RERA. Very, very important. RERA is not something which has been restricted only for the residential development. It's equally applicable for the commercial as well. It means a separate and self-contained part of any immobile property, including one or more rooms, enclosed space located in one or more floors. So all these kind of things that has been, clearly enlisted as to define what is apartment. And then this notification further goes on to say what is residential and what is commercial. An apartment intended for residential use as declared to the real estate regulatory authority or to the competent authority. Very important. It's not about how it is being sold or how it is being, put to use by the prospective buyer. No, these are not the conditions. When you give a declaration in RERA, basically, that's a form which requires a lot of details that needs to be given. Now, how you furnish this declaration to the real estate regulating authority, to that particular authority in the RERA. Now, as per that declaration, if you declare that it is for residential use, then that apartment is a residential apartment. If you declare that it is for commercial use, then it is a commercial apartment. So it's as simple as that, right? Now, the next thing is real estate regulatory authority That is again, the definition is, linked with RERA. I'm not getting into the definition. Now, there is another thing called as competent authority. There are two things. One is real estate regulatory authority. The other one is a competent authority. The competent authority, as mentioned in the definition of commencement certificate, I'll also be discussing on that. What is defined in the commencement certificate means the local authority or any authority created or established under the law for the time being in force. So why is this very important? Is because, as I already told you, some of the projects are probably not being covered under RERA. Then it is the local authority who will be the competent authority, right? Now, the next most important definition out of all the definitions, all these definitions, is the definition of a promoter. Now, promoter definition is not directly defined in this notification. Promoter definition has been directed to RERA. RERA clearly defines who's a promoter. Literally, it's a huge definition which covers anybody into that ambit, right? Now, person who constructs naturally, so which means a builder. A builder who constructs or causes to be constructed an independent building or a building consisting of apartments, however you do it. But very important, I go back and again I insist, for the purpose of selling or converts an existing building or whatever it is, for the purpose of selling. The intention to sell is very, very, very important to call one as a promoter, which means what? A builder would probably get categorized under someone who is providing a works contract services, and he will not be a promoter if there is no intention to sell any of the apartment. But even if there is an intention to sell one apartment also, then the particular project would be covered under RERA, and then this person who is a builder or a developer, whatever you call, he'll be a promoter. A person who develops land into a project, whether or not the person also construct the structure, right? Now, he is also covered under promoter, but doesn't mean I'm not talking about the applicability of GST. I'm only talking about who is called as a promoter, because as we, see the entire, framework of all the provisions are applicable mainly for the promoter. So it's very important to establish who is the promoter, whether or not the person also constructs structure, and then again it reinsists for the purpose of selling. Now I come down to also say any other person who acts himself as a builder, organizer, contractor, developer, right, and to be acting as a holder of power of attorney from the owner of the land. Now that person is also called as a promoter. But again, we reinsist, it's for developed for sale, provided it is developed for sale. The intention to sell is something that is very, very important, that is being reinsisted. So then they are called as a promoter. Now, this also clarifies one more thing. The explanation clause is very, very important, because there are some of the projects where there is a separate developer and there is a separate builder. Now, who is a promoter here? Because the entire GST taxability, the responsibility falls only on the promoter. Now, there is a separate builder and there is a separate developer. Then whom do you call as a promoter? Now, very importantly, the explanation clause sorts out this as well. For the purpose of this clause, where the person who constructs or converts a building into apartments or develops plot for sale, and the person who sells apartment or plots are different person, which means the builder and the developer are two different persons, then both of them shall be deemed to be the promoter and shall be jointly liable for such function and responsibilities under RERA. Right? So very important definition which one has to go through to determine ultimately who has the accountability of complying with RERA, which means incidentally complying with the GST tax liabilities as well. Now the next one is project. What is a project? Whether it can be a project, can be real estate project or a residential real estate project. That is what we call as REP and RREP. The next very important definition. Now, what is a real estate project? A real estate project means the development of a building or a building consisting of apartment or converting an existing building or part thereof into apartment or a development of land into plots or apartments. So whatever you call, everything is being covered for the purpose of selling. Again, for the purpose of selling, that is being reinsisted. If you see every point that is being reinsisted, for the purpose of selling all or some of the said apartments or plots or building, as the case may be, and includes the common areas, very, very, very important, includes the common areas, the development work, all improvement structure, everything is being and all easement rights and opportunities belonging thereto. So everything together is being called as a real estate project. Now, the next important definition is what is a residential real estate project? Now, a residential real estate project, that is RREP, is nothing but is nothing but an REP, that is a real estate project in which the carpet area, very carefully you have to understand that this carpet area is also very clearly defined, that we will also be seeing in the next slide. Carpet area of the commercial apartment is not more than 15%, which means to say, let us say there is a overall structure. The land area doesn't matter. The built up area doesn't matter. What really matters is only the carpet area. Now you calculate the entire carpet area of that particular project. Now out of this carpet area, if the commercial apartment, for the commercial apartment also there is a carpet area. Out of the entire carpet area, let us say it is 10,000 square feet of carpet area. Now out of that, up to 1,500 square feet, that is up to 15%, if you are having commercial apartments, then also it continues to be a residential real estate project, which means what? In a real estate project, if you have up to 15% of commercial project, then it continues to, retain its nature as a residential real estate project. The 15% is not going to change your residential nature of the project. But if it exceeds 15%, not in terms of value, not in terms of mere square feet, it has to be calculated based on the carpet area. If it exceeds 15%, then this project is going to be called as a real estate project, which is not a residential real estate project, right? You cannot call it as a commercial project, but it is not a residential real estate project, which means it's a normal real estate project. Now, what is the difference between these two? I will come to it in a while, because the taxation of the commercial property is altogether different between these two categories. Now, before we get into it, we should also be aware of understanding what is a carpet area, because carpet area very specifically mentions as it means net usable floor area of an apartment. Usable floor area, that is what is very important. Usable floor area excludes, very specifically, it excludes the external walls, areas under service shaft, exclusive balcony or veranda. Even that is also being excluded, right? So exclusive balcony or veranda. There are a lot of private terrace, all these things are right? So exclusive open terrace, balcony, all these are not forming part of carpet area. Now, why is this very important? If you see, normally, if you see any of the real estate advertisement, they say 1,000 square feet is the built up area. Now, the 1,000 square feet built up area, if you see, there will be 3 balconies, there will be some kind of service area, and there will be a veranda, and there will be also this, private terrace. Even the private terrace, I'm not even talking about the common terrace, even the private terrace. So all of these things are normally included if you look into the way in which the project, the apartment is being sold. Let us say, they say that there is 1,000 square feet of apartment. Most likely, it will end up with, let us say, 800 to 850 square feet of carpet area after excluding all these. But what is included is the internal partition wall, right? Which means between the hall and the kitchen, there is a partition. Between the bedroom and another bedroom, there is a partition. So these walls, which are occupying these internal partitions, that is also included in the carpet area. But the external portions, that is what you call as external walls and the balcony, veranda, all these are not included in the carpet area. So definitely 100% sure there will be a difference between what is a normal way in which an apartment is being sold, the built up area that is being told, and the actual carpet area, there will be a difference, right? So they also go on to define what is an exclusive balcony, veranda, what is an exclusive open terrace. Everything has been very clearly defined in the RERA. So as I said, all these orange are RERA definitions. It's not a definition under the GST notification. The next important definition, which is under this notification, not in RERA, is floor space index. That is nothing but the FSI, the ratio of total floor area, which means, let us say, for example, there is a ground, the entire land, say, for example, 3,000 square feet. Now, out of that 3,000 square feet, the building is being built over a 2,000 square feet area, and then this 2,000 square feet is into 5 floors, right? Now, there is a ground floor plus another 4 floors. So, 2,000 into 5 is 10,000, whereas the entire land area is 3,000, right? So, the ratio of the buildings total floor area, that is the gross floor area, in this example is 10,000 square feet, to the size of the piece of land upon which it is built. So it is 10,000 by 3,000. So 10 is to 3. 10 by 3 is what is the floor space index. So FSI has to be calculated in this manner. Now, the next important definition, which is not from the RERA, which is exclusively for GST, because for RERA, it doesn't matter. There is no concept of affordable, non-affordable. You cannot call it as non-affordable because end of the day, affordability is a relative concept of whether the buyer can buy it or not. But somewhere they have used this word in the notification 3/2019. Affordable residential apartment. There is no such distinction in RERA. Affordable residential apartment. It's basically to give you two rates, 5% and 1%. Now, what is affordable? A residential apartment wherein the carpet area, again, we go back to the carpet area definition. Carpet area not exceeding 60 square meter. Very important, it's not 60 square feet, 60 square meter or 90 square meter. 60 square meter, because I know it's quite natural. You get 60 square meter in the city, you get equivalent to 90 square meter in the, other than city, other than metropolitan, right? So in fact, it's not just 90, much more than that, but this is how it has been defined in the notification. So when the carpet area, that is 60 square meter, if you have to convert it into square feet, it is 645 square feet. Because, somewhere the notification only talks about square meter, but practically everywhere it is only in square feet. That's how, the transaction actually happens in real estate. In metropolitan cities, it is 60, and in non-metropolitan city, it is 90. Now, which is metropolitan city? That is also very clearly defined in the notification itself. Bengaluru is also included. Bengaluru, Chennai, Delhi, NCR, Hyderabad, Kolkata, Mumbai. So all these are being defined as metropolitan cities. And then the next criteria, very important, you have to understand that both the criteria should be satisfied. Carpet area should be within 60, within 90. Then I'll say, okay, this is affordable. Affordable means what? They give you the concessional rate of 1%, right? Instead of 5%. Two conditions, both the conditions are to be satisfied. Condition number one is carpet area should be within the 60 square meter or 90 square meter. The second condition is gross amount charged is not more than 45 lakhs. Now, what is this gross amount? That is also very clearly defined. The gross amount includes, it shall include, it is a sum total of consideration charge for the services and transfer of land. Gross amount meaning both land, building, all put together, that value should not exceed 45 lakhs. Here, there is no distinction of metropolitan city, non-metropolitan city, no distinction. Ultimately, you buy it within 45 lakhs. Then I will call it as affordable unit. So, because 45 lakhs is actually nothing these days for a real estate purchase, right? So 45 lakhs, up to 45 lakhs is the total gross amount charged. So the gross amount charged includes both land value as well as the construction services value. So land and building put together value, it should be within 45 lakhs. The one more thing that should also be added in this is any amount charged by the promoter from the buyer of the apartment, including preferential location charges. Sometimes, they may have this preferential location, whether it should be in the, east facing, or sometimes it could be because you get some better view of from the property. So whatever be the preferential location and developmental charges, parking charges, common facility charges, whatever name you call it, all put together, include everything. And then you derive what is the total gross amount charged. If that gross amount does not exceed 45 lakhs, then it is called as an affordable residential apartment. So remember, both the conditions are to be satisfied. Only then the particular apartment is eligible for the concessional rate of 1%. See, there may be scenarios wherein within one particular, project itself, there'll be few units which are affordable, few units which are, other than affordable, which are at 5%, few units at 1%. Quite possible. There is no restriction at all. But only thing is, it has to be determined for every single. It's not at a project level. It is at a particular apartment level, right? So the REP, RREP has to be defined at a project level, particular project level. But this affordable or other than affordable is for a particular apartment level. It has to be determined. Now, as I told you, why is this, REP and RREP, or there is a distinction between these two? end of the day, whether you call it as REP or RREP, whether you call it as a residential real estate project or a real estate project, it doesn't matter. In both the situation, for the residential apartments, the tax rate is only that 5% or 1% without ITC. No confusion. Now we'll come to the rate of taxes. Okay. Now, whenever it is affordable residential apartment, which means I go back to the same definition up to 45 lakhs, and there is a square meter definition as well, up to 60 square meter and 90 square meter. In those cases, if it is affordable and it is a residential apartment, then the rate of tax, what we normally call is 1%. But is it actually 1%? No, it is actually 1.5%. But what happens is, from the value, the total value, which means the value including land and building, on that overall value, you are being given to reduce 1/3 of the value towards land. It is deemed towards land. So after reducing that 1/3, you are left with the 2/3. On the 2/3 value, if you apply 1.5%, it is as good as applying 1% on the total value. That is why it's being commonly called as 1%, 5%. But in reality, the rate of tax is not 1% and 5%. It is only 1.5% and 7.5%. Now, when I say 1.5%, it is 0.75 CGST and 0.75 SGST. Now, same way, if it is 7.5%, it is 3.75 and 3.75 CGST, SGST. Right? Now, this rate of tax has to be applied on the value after reducing 1/3 of the value towards land, and hence it's on the 2/3 value, right? Now, if you indirectly calculate, it works like that. Now, one important thing that we have to be aware of when it comes to your GSTR 1 and 3B disclosures, especially in GSTR 1, how do you disclose the transaction? Okay, very, very important. Many people do this mistake. So what needs to be done is that the taxable value, let us say, I go back to the same example. The particular apartment is 1.5 crore, right? So out of 1.5 crore, your taxable component is 1 crore. So which means in your GSTR 1, you need to declare 1 crore as taxable value. Tax amount will be on this 1 crore. You have to calculate 3.75 plus 3.75%. And you need to select the rate of tax, which is 7.5% rate of tax. And finally, there is another column, which is the total invoice value. On the total invoice value, you can always add back that 1/3% also, and then you can give the overall gross amount. That is fine. But having said that, the taxable value has to be calculated after reducing the 1/3 portion towards the land. Now, coming back, whenever it is affordable, it is 1.5%. Whenever it is residential other than affordable, which means you are not able to meet both the criteria, which means even if one criteria is not met, let us say, for example, the particular apartment is less than 60 square meter and it is in a metropolitan. But after including all the total gross amount, it is exceeding 45 lakhs. Then it is not an affordable residential unit. It is other than affordable, which means it has to suffer 5%. That is 7.5% tax has to be paid on that particular unit, right? Am I making it clear? Now, this is very important that for a residential apartment, this rate of tax of 1.5% or 7.5% remains as how it is, irrespective of whether it is a real estate project or a residential real estate project, as far as the residential apartment is concerned. Now, the next one, which is a commercial project, the commercial apartment is concerned. Now, as far as the commercial apartment is concerned, if the commercial apartment is forming as part of a residential real estate project, that is RREP, right? I'm actually sorry, here there is a slight difference in, this is RREP and this is REP, for the sake of understanding, because only in a residential real estate project, the commercial apartment also continues to enjoy the rate of tax which is equivalent to the residential apartment. So which means what? Up to 15%, let me just change it quickly. Yeah. So in a residential real estate project, wherein the carpet area of the commercial is up to 15%, then even for the commercial apartment also, the rate of tax would be equivalent to the rate of tax which is otherwise applicable for the residential apartment. So in this case, even for the commercial apartment also, the rate of tax would be this 7.5%, that is 5%. That would be applicable. Here there is no concept of affordable, non-affordable, right? Now, affordable, non-affordable is only for the residential. When it comes to commercial, it's only 7.5%. That is 5% on the value after reducing the land component. Now, what is it for real estate project that is other than residential, wherein the commercial element is more than the commercial apartments carpet area is more than 50%, 15%. In those cases, the commercial apartment would be taxed at 18%. Now, very, very important, the striking difference between this 1%, 5% and this 12%. Now, why do I say 12%? It's because it's 18% on the value after reducing 1/3 from the land. So the effective rate is actually 1%, 5%, and 12%. These are the three rate of taxes. Now, very important thing to understand is whenever it is under 1% or 5%, there is no ITC. If the commercial apartment is taxed at 18%, that is 12% net effective rate of tax has been charged only to that extent of carpet area under Rule 42, ITC is eligible, which means for the remaining, the ITC has to be reversed under Rule 42. Am I making it clear? So only on the commercial portion wherein rate of tax has been paid at 12%, the ITC is eligible. For 1% and 5%, no ITC. Which means if there is a project wherein a real estate, where there is a residential real estate project, there is absolutely no ITC. It is straightforward case of 1% and 5%. And again, I repeat, when it comes to commercial, don't try to do this testing of 60 square meter, 45 lakhs, nothing matters. If it's commercial in nature, straightforward, it is only suffering the 7.5% rate of tax. Now, moving on. The next one, for the ongoing projects. Now, what is this ongoing project? It is the transition before and after 1st April 2019. Now, how do we determine something as an ongoing project? The test is very simple. The commencement should have happened before 31st March and the completion should take place after 1st April, right? So, which means if the completion has also happened, so the CC itself has been obtained before 31st March 2019, then there is no question of taxation under the transitioned, that is the rate of tax with effect from 1st April 2019 is not applicable. So let us say, for example, CC has been obtained before 31st March, right? Probably some leftover consideration is only received after 1st April. Now, this also has to be paid under the tax rate which is applicable before 31st March, right? Now, before 31st March, it was completely, the input tax credit was also being allowed. There is no 5%, 1%, nothing was applicable. ITC was allowed, but ITC is restricted only for those properties which has suffered taxes, that is before bookings that has happened before completion certificate or first occupancy. On those apartments, ITC is eligible. For whatever that has been sold or booked after this completion certificate or first occupancy, no GST. So quite naturally, no ITC. That is how the previous regime was until 31st March 2019. Now, with effect from 1st April, that is the rate of tax structure which I have explained now. Now, coming back, what do you call as an ongoing project? An ongoing project should have commenced before this, but the completion should have happened after 1st April. So, which means the commencement itself takes place only after 1st April. There is no question, it has to be only under the new rate of tax. If the project has got completed before 31st March, no question, it clearly falls under the old tax rates. Now, the question is, what happens for the ongoing project? It is very simple. If by default, it only comes under the new tax structure. That is the tax structure which I have explained now. Provided if the for a promoter wants a particular project to continue under the old rate, because there were a lot of workings that we used to do during this transition time to understand which is better, and accordingly we will actually choose the old regime or the new regime. Like how you have this now currently in the income tax, many people are doing this, whether I have to go under old tax structure or the new tax structure. We used to see how the cost benefit analysis, ultimately it's about paying the taxes. So some of the projects, but this is a project based option. It's not a taxpayer based option. It's not that I want to pay everything under the old regime. It doesn't work that way. For a particular project, if one wants to continue to pay under the old tax rates, wherein the ITC has been already availed, I want to continue to retain the credit and I'll continue to pay the taxes under the old regime. Then there is an option, and that option can be excised only subject to a particular declaration being a particular form being submitted in annexure, right? So this option was available. I'm not getting too much into it, but let me only give you a perspective of how it used to operate. Okay. So project which are completed before that, no option. It is only under the old tax structure. This is what I explained to you. If it is an ongoing project, by default, it is getting migrated to the new tax structure. And if at all they want to opt under the old tax structure, the form should have been already submitted. There is, all these form submission are all irrelevant now. That was only until 10th May 2019. That is the time limit which has been given for that. Now, next we are coming to the very important subject, joint venture development agreement. JDA, most popular way of real estate. Right? Because especially if you see in a city where there is no vacant land at all to do any kind of construction, 99% of the transaction or 99% of the real estate development happens only by way of joint venture development, right? So the joint development agreement, the very essential, I'll give you first of all an understanding of how this joint development project works. There are these three persons: landowner, developer, come builder, and there is an ultimate buyer. Most of the projects, developer and builder would be one and the same person. Some of the projects, developer could be a different person from the builder. Doesn't matter. Both of them are called as promoter. The law very carefully uses the word promoter everywhere. Nowhere it talks about developer or builder. If you see the notification, only it talks about promoter, right? So the promoter can be whether the promoter can be builder or developer. So there is this one person who is the landowner. This landowner has got a, let us say it could be an ancestral property. It's a very old building. He wants to remodel. He wants to, completely restructure and construct a new building. But he doesn't want to put his money into that construction, right? He wants to get a constructed apartment, but without spending any money. Now, sometimes the landowner, he approaches the developer, or the developer would approach the landowner. So ultimately, they form an equation wherein the equation is very simple. I will give you a developed, your house is a very old house. We will demolish it and then we will build a new apartment, right? You don't need to pay me any money. I will do the construction and I will give you a beautifully constructed new apartments. Now, for that, what you need to do is you need to give me some portion of share from your land. Until then, I was enjoying the UDS. Until then, the entire land was for me. I'm giving a very simple, vanilla transaction. The entire land was belonging to one landlord. In a real situation, there will be n number of landlords, right? So there could be an apartment where there are 8, landowners. Already that will be an apartment. Okay, that will contain 8 landowners. And then probably they will completely restructure and they will make it into, instead of 8, they will probably make it into 20. And they will get some allotment. So however way, it purely how the transaction occurs is based on the agreement between these parties. Okay, but the very important essential part is that the landowner compromises on his share of land for which he is receiving the construction in return. Now for the developer, he is investing his money to construct the property, right? So he is investing his money and in return, he is receiving the constructed apartment. So let us say there is an apartment which is constructed in which there are 10 units. Out of the 10 units, the landowners get 4 units and the 6 units are belonging to the developer. So ultimately, the developer will get 4 units. Out of the 4 units, the landowner will get 4 units. And the 6 units are belonging to the developer. promoter. Now, what this promoter will do is that the promoter will invest his fund and he will do the construction. And after construction, the 6 units is belonging to the developer, and this developer is going to sell the 6 units to the outside buyer, the ultimate buyer, and that is how he is going to make revenue out of this project. Right? Now, this is a win-win situation because the buyer is going to pay the money and buy the property. The landowner is going to get a new property, but without shelling out any money because he's only going to compromise on his land value. Now, using that, there are other more properties which are being built. Those properties are being, those apartments are being sold to this outside buyer, and that's how this promoter is generating his revenue. Now, this is a typical joint venture project. Now, what are all the major transactions which are taxable? Major taxable transactions in joint venture. Number one, which is the construction services, which is given by the developer or the builder to the landowner. So, as I said, there are 3 parties, right? So now there is this promoter who is in between. This promoter is now giving the construction services to the landowner. Now, this is one leg of transaction which is going to be taxed. The next leg of transaction, the second one, is the construction services which this particular builder or developer or sometimes even the landowner is going to give to the buyer. Now, how the landowner can give a construction services to the buyer? It's very simple because during the phase of construction, now the landowner has got 4 properties, right? So out of 10, I gave you example, 4 is belonging to the landowner. Practically, let us say there is only one landowner. What is that he is going to do with all the 4? He may want to sell 1 or 2 out of it. Let's say he is going to sell 2 out of those 4 to an outsider. Now, if the landowner is going to sell those 2 after completion certificate, after first occupancy, then this is completely outside GST. Because it's a constructed immovable property, land and building together. But if the landowner, out of his share of 4 property, he is also going to sell 2 during the construction phase itself, which means there is another leg of construction services wherein this landowner is also forming part of this overall construction services, and hence there is a construction services which is given by this promoter who is also happened to be a landowner to the outside buyer. Now, this is another leg of transaction which is taxable, which means purchase by the outside buyer, whether he is purchasing from the developer or from the builder or from the landowner, doesn't matter. Purchase by the buyer during the course of construction stage, that is before CC, before first occupancy, then that is the second leg of transaction which is getting taxed. The third important transaction is the transfer of developmental rights. The transfer of development rights, meaning the landowner, what is he doing? He is inviting the promoter. He is telling the promoter, you take my land, you do whatever that is required to make it suitable into a new civil structure. You are actually going to occupy that property. I allow you to enter into the property, demolish my existing property, do whatever that is required, take whatever is the authority permit that is required, register this under RERA, do literally that, whatever that you want, develop a civil structure. So this is basically like I'm giving a complete rights over this property to the builder, to the promoter. Now, this is the third leg of transaction which is taxed. The transfer of developmental rights, which is transferred by the landowner to the developer or the builder. This is the third leg of transaction. Now, this particular transaction, very, very, very important shift as compared to how it was before 31st March 2019 and with effect from 1st April 2019. The major shift is that this transfer of development rights, on that also the liability, the responsibility to pay the tax liability is only on the promoter and not on the landowner. The supply is actually being made by the landowner to the promoter, but the promoter is only responsible for payment of this transfer of development rights under reverse charge mechanism. There is a major shift with effect from 1st April 2019 that we have to be aware of. Now, important caution. How you agree upon in the agreement is very, very important, right? I'll tell you why. Because whatever is it is very important to agree upon in the JDA for the tax collection by this developer, that is by this promoter from the landowner. Because what happens typically is that the landowner may not want to pay any money at all. He may not want to pay any money, right? So he'll say, you just do the construction. That is all what I want. And then if GST is there, that is your responsibility. You give me constructed apartment. But the responsibility to pay the tax, even though there is no consideration, very importantly, even though there is no monetary consideration, I would not say there is no consideration, there is a consideration in the form of compromise of the UDS. Correct. For the construction services which the promoter is giving to the landowner to give for the apartments which is being allotted to the landowner, there is a construction services which is given by the promoter to the landowner. Now, on this, tax is payable under forward charge mechanism, and that tax responsibility is on the builder. Practically, this landowner would be a person who doesn't want to spend any money. But it is very important to agree upon that it's not merely, some of the agreements could be very poorly drafted and then they have to go for arbitration. So to avoid that, it's very important as to how the JDA is being agreed. So it's very importantly, they need to agree that the landowner is responsible for payment of this tax to the builder, and then this buyer, that is this builder is responsible for the collection of this tax from the landowner and remittance to the government. Right? So to that extent, it has to be very clearly agreed upon. If the developer wants to make sure that this tax is being properly collected and then it is being remitted to the government. Some cases, they may also agree upon wherein the ratio itself, they may want to compromise on some more. Okay, fine. You want to pay tax. What is the tax amount? For that, I'll also compromise some more UDS. You take away one more apartment, do whatever you want. Ultimately, I don't want to pay any money. Okay. Then the transaction should be, the JDA has to be entered accordingly, wherein the UDS is also, the allotment between these two parties are being agreed accordingly, wherein I get probably more share than what I have agreed, so that share I sell it outside and that brings me money for me to pay the tax. But the very important point that one has to be aware of is that whether you collect it from the landowner or not, it is your problem. Ultimately, for the government, it is the promoter who is responsible for payment of taxes, right? Now, same thing when it comes to the outside buyer also. Whenever there is a sale to the outside buyer, when the sale is made out of the property that belongs to the developer, then the developer is responsible for the payment of taxes. But if it is sold by the landowner, out of the allotment that is made to the landowner, in my example, out of the 4 properties which are allotted to the landowner is responsible to take a GST registration. First of all, he has to take a GST registration. And then he should also discharge tax. Now, provided this sale or this particular bookings happens before CC, during the construction phase. I repeat, if the sales by the landowner has happened after CC or after first occupancy, no tax. Which means if whatever that he wants to sell only after completion, then there is no requirement to take a GST registration at all. But prior to 31st March 2019, that's not how it was. For the payment of TDR, he may want to have, he may have to take the GST registration. Now the TDR responsibility also completely shifted under reverse charge mechanism only on the promoter. The promoter is only responsible for payment of reverse charge tax for the TDR as well. Now, coming to the next portion, which is transfer of development rights. You call it as development rights, you call it as FSI, you call it as long-term lease, doesn't matter. Sometimes it could be in the form of only a compromise, sometimes it could also be in monetary, sometimes it may not be in monetary. So irrespective of the monetary or non-monetary element of the consideration, transfer of development rights is subject to GST. As I said, before 31st March, it was under forward charge. Now it is under reverse charge. Now GST on TDR, very importantly, for the residential unit. For the residential unit, for bookings that has happened for units which are booked before completion certificate, to that extent, proportionately, no TDR. TDR is exempted. I'll give you a very simple example. The same example I go back to. The apartments is being developed, 10 units, 4 units allotted to the landlord, and 6 units are retained by the developer. Okay. Now, what happens is the entire the tax has been paid by the promoter on the 4 units which has been allotted to the landowner, as well as on the 6 units which is being sold to the buyer before completion certificate. Everything, all the bookings, everything has happened before completion certificate or before first occupancy, which means what? All the 10 units have suffered GST at the rate of 1% or 5%. I'm talking about residential. Okay. Everything has suffered GST. Then TDR is completely exempted. No TDR. Which means what? If at all, let us say, for example, out of the 10 property, 2 properties are being sold after completion certificate. Then proportionate to that 2 property alone, TDR has to be paid under reverse charge mechanism by the promoter. Right? Now, how this TDR has to be calculated and paid? It is 18%. The rate of tax is at 18% on the comparable value. I will come to it, right? So this transfer of development rights, this TDR is to be paid only to the extent on which GST is not suffered for those apartments because the bookings have happened after CC, which is outside GST. So in my example, 2 apartments, this 2 apartment could be belonging to the promoter or this 2 apartment could be belonging to the landowner. Doesn't matter. Ultimately, have you paid GST on all the 10 properties, on all the 10 apartments of this property? If all the 10 apartments have suffered GST, then no TDR. If 2 of them are not suffered because there is no booking before GST, which means after, before completion certificate. So whenever the booking happens only after completion certificate, it is an immovable property. So no GST. Then proportionate to those 2, you have to pay the TDR. Right? Now, when you pay the TDR, though it is, taxable at 18% on the developmental rights transfer, there is also a ceiling that the amount of tax is limited to 5% or 1%, which otherwise would have been discharged, which means what? Assuming you would have paid on the entire, 10 property at 5% or 10%, what is that you would have paid? Now that you have not paid on the 2 property, or for that you are going to pay proportionately the TDR. But though the TDR is to be calculated at 18% on the market value, it is very important that you can restrict that amount to this 5% or 1%, which otherwise you would have paid had the bookings happened before CC. Clear? So this is how the TDR has to be paid. Now coming to the commercial unit, 18% GST on TDR is payable by the promoter on reverse charge mechanism. No ceiling, nothing. ITC is eligible for such reverse charge mechanism payment of TDR because output is going to be at 18%. So very important, commercial, you have an output at 18% on which ITC is anyway eligible. Just like how any other ITC is eligible, even the TDR ITC is also eligible. Now, owner's tax liability and the ITC eligibility. So the next important, transaction to be analyzed is from the landowner's perspective. I told you, whenever the landowner is selling his share of allotment to an outside buyer during the phase of construction, that is before CC or before first occupancy, then on those property, the landowner is supposed to collect and pay this tax of 1% or 5% as if, he is a promoter, right? Now, for this purpose, the landowner is supposed to take the GST registration. Now, the important thing is that when I told you there are three legs of transaction, correct? So which means what? The promoter for his construction services which he is giving to the landowner for those apartments, he is anyway charging the tax under forward charge mechanism. Next, the landowner is also again going to charge 5% GST when he is selling it to the next buyer. Now, all this happens only during the construction phase. I'm not talking about after CC. I'm talking about before CC. Promoter is going to charge and collect taxes from the landowner at the rate of 5%. Now, further, this property is being sold by the landowner to the outside buyer at the rate of 5%. And again, there is a GST at the rate of 5%. So, if you leave it as how it is, this one property will be subject to two types of GST levy. One levy is from the promoter to the landowner. The second leg of levy is from the landowner to the prospective buyer. This would result in cascading effect, or I would say double times taxation. To nullify the impact, what the provision which has been given in the law is that this landowner, anyway, he is going to take a GST registration, he is eligible to take input tax credit on the tax which is being paid by the promoter, which he is collecting from the landowner, and he is remitting it to the government. So that there are these three parties. Promoter is giving the construction services to the landowner, and then the landowner is giving similar construction services to the prospective buyer, because this is during the construction phase, right? So now the landowner can take input tax credit on the tax which has been paid to the promoter, and that ITC can be utilized towards further payment of output tax liability that he is going to charge on the buyer. So this is a very, very important exceptional situation where, though it is 5%, see, it need not come under 18%. The promoter is going to charge only 5%. Still, the landowner is eligible for taking credit of this 5%. Now, the landowner is only going to charge 5% on his output towards further sales to the buyer. Still, he is eligible for ITC on this particular transaction. But remember, provided there is an output at the rate of this 5%. I'm using 5%. Obviously, it has to be replaced by 1% wherever it is affordable, right? Now, again, very important aspect that one has to remember is this ITC. Whenever I say ITC, quite naturally, I told you at the beginning, though there is a separate set of provision which has been carved out for real estate, the real estate developer is also subject to all other provisions of GST, which means what? Section 16 is still applicable. So if the landowner wants to take this credit, quite naturally, the builder or developer must raise a tax invoice, and that has to be reflected in GSTR 2A of the landowner, right? So this equation has to be completed. But also remember, if this credit is eligible only where output tax has been paid by the landowner. In my example, out of the four apartments which are being allotted to the landowner is intending to sell only 2 apartments. Now, very important, the promoter has to pay tax under forward charge mechanism on all the 4 properties which are allotted to the landowner, no doubt. But having said that, out of the 4, if the landowner is going to actually have further output tax only on 2 property, which means 2 property he is not eligible for ITC, which he is going to retain because it's a cost for him. Only 2 is intending to sell further sales. On that, let us say 1 is booked before CC, 1 is booked after CC. Then ITC is eligible only for the one which is booked before CC, because only on that one property the landowner is going to pay the taxes. For the remaining one booking which has happened for the landowner after completion certificate, there is no ITC because there is no further output tax liability, right? So I am making this clear. Now, the next aspect where we are going to enter is there is one issue in this particular ITC flow. Now, what happens is that the landowner, for the allotment, what is received from the promoter, the promoter is going to pay the tax only during the completion. There is a time of supply. The time of supply very clearly says that the developer is liable to pay GST on the construction services provided to the landowner in lieu of this developmental rights only at the time of issuance of the completion certificate or first occupancy. Until then, there is no liability to pay the tax. Now, what happens in the case of this ITC, where there is a further supply at the rate of 5%, this landowner is actually collecting the money from the buyer. Now, once you collect the money, you are responsible for payment of tax. Correct? Now, the collection of money would have happened during the course of construction. So, quite naturally, the tax liability also has to be discharged during the course of construction. But what happens is the ITC, which is eligible for, that ITC is actually being passed on only at the time of CC. Now, this creates a timing difference. See, first I'm responsible for payment of tax liability, and then only I'm getting the credit. What is the point in getting the credit? Because this credit is only going to get accumulated in my hand. I will not be able to utilize it because I already paid the output tax liability. So, to nullify this impact and also to ease this cash flow issue, already suitable amendment has been made in the notification to say that yes, the liability, the time of supply is only at the time of CC, but the promoter is free at his option to raise the tax liability in advance and also to discharge the taxes in advance. So by doing this, what happens is that only to that extent where the landowner is responsible for payment of tax towards the ongoing sales during the construction phase to the outside buyer, since the landowner is responsible for payment of tax at the rate of 5%, correspondingly, the landowner can insist the promoter that you also please raise the tax invoice on me and you also please pay the taxes. I will give you the taxes. You please remit this tax and get it reflected in my GST or 2A so that I take the ITC before I pay the tax liability on my further sales to the outside buyer. So this is going to iron out the issue which has happened, which was previously existing. So the next one, but one aspect which is still remaining is that this has been made only with effect from 2nd June 2021. But what happens before that? Somebody has made some transaction before that, wherein there is an ITC which has got accumulated after the discharge of output tax payment. Now, can I get refund of this? The law does not permit. Practically, if you see section 54, subsection 3 for refund, it is construed only for two scenarios. That is, one is zero rated and the other one is inverted duty structure. This does not fall into both. So one may not be able to take the refund of that. That's going to be an altogether different battle. Ideally, this could have been settled better had there been a clarification to that extent, at least for the past transaction. Now, going forward, it has been, sorted out because the notification also explicitly says that it is only with effect from 2nd June 2021. Now, what happens before that is still a matter under dispute. Now, inward supply from unregistered person, the next important responsibility that is cast on the promoter, very, very important. If you all remember, when the GST law was introduced in 1st July 2017, there was this one provision which said, whatever you purchase from any unregistered person for more than 5,000 rupees on everything you pay tax under reverse charge mechanism. That's probably one of the most difficult provision for any industry to comply with, and hence that has been struck down. I mean, they have withdrawn within 3.5 months. Only until 13th October that provision was even there, and then they have immediately withdrawn. And later on, that 94 itself has been completely, removed. The entire charging provision has been changed to say that only for those notified goods and services, only for those notified categories, this would be applicable. Now, the first thing to get notified under that is this real estate transaction. What happens for the promoter? See, now your output tax is at 1% or 5%, no ITC. So quite naturally, the tendency could be that let me take all my purchases from unregistered person so that my ITC is not, anyway, I'm not eligible for ITC. So whatever is the tax on my inward supply, that becomes a cost for the promoter. So in order to save the cost on these inward transaction, one may want to go for purchases from unregistered person. So in order to avoid or in order to discourage such kind of practice, this particular provision has also been additionally, made to say that whenever your purchases from unregistered person is restricted to only 20% of your total inward supply, which means what? At least 80% of the input and input services should be purchased from registered suppliers. This is an additional responsibility for the promoter. Now, what happens if it falls below 80%? Let us say 75%. At the year end, I have to calculate, and then in my calculation, 75% I'm complying. So for the remaining 5%, for to that extent of this deficit, I need to pay the tax under reverse charge mechanism at the rate of 18%. Right? Now, another important aspect to factor in this is that this is for other than cement. If it is cement, strictly cement has to be purchased only from registered person. Any purchase of cement from unregistered person will straightforwardly suffer reverse charge mechanism at the rate of 28% because cement is subject to 28%. Here, that ceiling of 80%, that 80-20 doesn't apply, which means what? Let us say your 90% of your purchases is from registered dealer, right? So which means you have only 10% from unregistered dealer. But out of this 10%, you have 5% of cement purchases. Now, doesn't matter, even though you are complying with that 80% criteria, still, whenever there is an element of cement purchase from unregistered dealer, that needs to be definitely paid under reverse charge mechanism at the rate of 28%. Am I making clear? Now, in order to calculate this criteria of inward from input, the input and input services, one need not include the land transfer because obviously in a construction overall, land is also one of the input. But the transfer of development rights or those kind of UDS transfer, all these kind of inward is not to be included. Value of electricity and the high speed diesel, motor spread, natural gas, because all these are outside GST. So quite naturally, it will not be taken as part of it to evaluate whether it is being taken from the registered person or not. The next one is salaries and wages. So salaries and wages is completely outside GST. So naturally, this also there is no question of registered person, unregistered person. But for all practical purpose, the salaries and wages will have some relevance because in real estate, there are a lot of subcontracting which happens. So when I say salaries and wages, I'm only talking about, in fact, the salaries and wages are not even being used in the notification. The notification uses the first two categories only. Now, why am I bringing the salaries and wages is because, quite naturally, let us say there could be 40% of your cost could be relating to salaries and wages, right? So that's not even an inward because salary is completely outside GST, right? But what is very important to determine here is that should be forming part of an employment agreement to get it carved out of GST law. If there is no employment agreement, if there is no contractual employment contractual obligation, if it is out of a subcontracting, you can treat it as much as any other third party services, then that will also get covered for the purpose of evaluation of this registered or unregistered person related inward supply. So that's again another aspect to be taken care. Now, this evaluation has to be done only at the year end. You need not be redoing on a monthly basis or a periodical basis. This has to be done only at the year end. So at the year end, look into the total inward supplies that has happened for the year as a whole. See to it at least 80% has been purchased from the registered person. Let us say if there is 75% only, then for the remaining 5%, straightforwardly, you don't need to mention which party it is, what is it relating to, nothing needs to be done. Straightforwardly, tax has to be paid under reverse charge mechanism. Next important thing is no ITC. Tax should be paid, no ITC, because anyway on that 75% also you don't have ITC. Same way this 5% also no ITC on which you are paying this reverse charge mechanism. No need of evaluation of rate of taxes for that. Straightforward, it is at 18%, right? The other conditions which has been prescribed in this notification 3/2019 that one promoter has to comply with is that payment of tax is strictly through cash ledger. No ITC. For this 5%, 1%, it has to be very strictly through through cash, which means what? Maybe you have got, credit accumulation due to some other project in which there is a commercial project. Let us say, there are two projects for the same promoter. One is a commercial project. The other one is a residential project. So this residential project, no ITC, 5% or 1% tax has to be paid. Now I have another project, which is a commercial project wherein I am eligible for the ITC. This month I have got bookings only in residential project, but I have ITC accumulated due to commercial project. Now, can I use this ITC, which is a eligible ITC, to discharge this tax, which is on residential project? The answer is no. The law very clearly, the notification very clearly says that this 5% or 1%, the tax that you are discharging, it has to be mandatorily only through cash ledger, no credit. Right. So this is also important in order to evaluate for the transition, that is the ongoing projects as of 1st April 2019. If that is under the new rate structure, naturally the ITC is also not eligible. If you have any ITC accumulation out of the past also, that also cannot be utilized. Now, maintenance of project-based accounts for inward supplies for registered and unregistered person. So this RCM, you need to maintain it project-wise. It's not for all the projects put together. Project-wise, it has to be determined. Maybe there is one project wherein you have got 95% purchases from registered person. Now, can I offset it for the other project wherein I have got 75%? No. You have to determine it project-wise, right? And that has to be evaluated at the year end. Now, payment of taxes is subject to 80% limit that I have already told you. Cement is straightforward 28%, no 80%, nothing. Non-availment of ITC, reversal of credit, and most importantly, there is a recent circular also, 1 or 2 years, the circular has been given of how the ITC related disclosure has to be given in GST R3B, wherein previously we never used to disclose what is reversal and all those things. In real estate, it is very important that you have to show the availment and reversal separately, right? Now, this is not mandated through any act or any notification. It is only through a circular, right? So the availment has to be disclosed, and then the reversal should also be separately disclosed in GST R3B. Now, to sum it up, for a promoter, the list of responsibilities is really huge. Now, look at it. First of all, he has to comply with a lot of RREP provisions, right? So outside GST, RREP related regulations, even income tax is also complicated. And now coming to GST, there is a big list of complication. The multiple levels of responsibilities are there on a promoter. So first one is he has to pay GST on the construction services which he is rendering to the customer, that is the outside buyer, GST on construction to the landlord, and if the entire apartment or the entire project is covered under GST, then no TDR. If anything is sold after, anything is booked after CC, then to that extent, proportionately, GST has to be paid under reverse charge mechanism on the transfer of development rights. This is a transaction on which the landlord is the supplier. Still, the promoter should only pay the tax as a recipient under reverse charge mechanism. And then GST on RCM wherever the purchase is made from the unregistered dealer subject to that 80% limit. Then he should also ensure that GST payments are being made to the vendor, because there are registered person at least 80%. Then the tax, there is a responsibility for the promoter to pay the tax also to the developer, that is to the registered dealer from whom the inward supplies are being made. And then ITC availment and reversal for the commercial apartment. When it comes to residential apartment, no ITC. But for the commercial apartment, they should also keep a track of ITC availment. So whenever there is an ITC availment, the reversal also takes place under Rule 42 based on the carpet area. Now, some of the other disputes which I want to quickly discuss, but we have very little time. I just want to understand to what extent, we can get into some few more issues before we go for Q&A, or should we extend, not extend? Because it's a vast topic. I would like to hear from the coordination team. Impreet or Smita ma'am? Okay, since I don't get any response, let me take the liberty of Impreet. I just want to understand to what extent we can slightly extend.
Hello.
Yes,
Madam, you
Smita
can
ma'am.
extend. We can take some time, of course. You can take some question and answers. We can extend for 10-15 minutes, not a problem.
10-15
5-10
minutes
minutes
is fine,
we can,
right?
we can extend.
5
Please take
minutes, okay. So maximum we'll try to close it by 7:10 or 7:15 before that, yeah?
Yeah.
Sure, thank you, ma'am. So yeah, before I open for the, we move on to the Q&A, I believe, most of your queries should have been addressed by now. But anyway, I'll also quickly touch upon the valuation related issues and time of supply, because there is one important landmark decision also which has been part of this valuation issue. Okay, so now coming to the valuation, the first thing that we have to understand is, as per section 15 subsection 2 clause A, value shall include all the taxes, duties if charged separately by the supplier. Now, very important point, because when you draft the agreement, how the agreement should not mention that this is the total price for the apartment plus stamp duty, and all that inclusive is the price. If you give it that way, there is quite a probability that this, the GST authorities may ask you to pay GST on the stamp duty component as well, because value of supply includes taxes, duties as well, if it is charged by the supplier. Now, you have to very clearly say that this is not being charged by the supplier. This is actually, see, technically the stamp duty is being borne by the buyer, and it's the buyer who is paying the stamp duty. But practically what happens is the buyer will actually make this tax payment, the stamp duty payment also to the promoter, because the promoter takes care of the registration part as well. Now, it's very important as to how you draft the agreement to make sure that this kind of litigations are not being taken up. The next one is valuation for landowners allotment, right? So on these lines, see what happens is the valuation rule says, there is an order. It's not that you can opt any of these. Rule 27, there is an order, there is a sequence, right? When the consideration is not in money, because for the landowners allotment, most of the time there is no monetary element that is involved. Open market value, if there is no open market value only, you have to go to B, C, D and all those stuff, okay? Had the law been liberal in giving you the option to directly go for the last methodology, which is the cost plus 10%, this issue will not even crop up. But the law is very particular in saying that similar apartment handed over to outside buyer is what is the open market value. Now, because of this poses a huge tax burden for this particular transaction. In fact, sometimes the construction, more than the construction, it's almost equal to the construction cost. To that extent, the tax alone will be, right? So I'll give you I'll also explain you with an example. Okay. Let us say there is an apartment which has been handed over to the outside buyer. Now, what happens is whenever you pay tax for the landowner's allotment, you have to derive the open market value. Open market value is nothing but anyway, in the same apartment, you have another allotment which is made to the outside buyer. So that can be an open market value. But if you consider that, what would happen is that because of the deeming fiction of 1/3 towards land, there is a whole lot of confusion here. Now, the land which has been allotted to the outside buyer, especially whenever it is in a prime location, where you call as prime location, the metropolitan cities, where the value of land is only very high as compared to the construction. The land value alone would be 12,000 rupees per square feet. Whatever I'm giving you here is, let's say, per square feet value. So 12,000 rupees per square feet out of the 15,000 rupees. So for the buyer, all inclusive quotation which has been given is 15,000. But practically out of the 15,000 square feet, 12,000 rupees per square feet is towards the land. And 3,000 rupees is all what is being incurred towards the construction. Right? Now, because of this, land 1/3 deemed valuation, what happens is the building value, that is the construction services related value, is deemed to be the remaining 2/3, which is actually 10,000 rupees. But if you look into the actual cost of construction, it's only 3,000 rupees as compared to the 10,000 value which has been derived. Now, because of this, there is a huge gap between what is the actual construction cost versus the construction cost which is being derived out of the deeming fiction which has been created for the land notional value, which is 1/3 of the total value. Now, this intensity is very high, especially in prime locality, because for the prime locality, the land cost is literally very huge as compared to the construction. I'm not getting into the example one by one for want of time, but broadly you would have, I hope you would have got the point which I'm trying to talk. Now, there is a very interesting and very important case decision in this regard from the Gujarat High Court. This is a landmark judgment, Munjal Manish Bhai Bhatt. What the Gujarat High Court says is that when the law very clearly, see, when the specific value can be determined, we have to go by the determinable value. In this case, you can clearly determine what is the actual land value. The land value is very clear. It is 12,000 per square feet. When that is readily available, when that is easily ascertainable, why do you want to create a deeming fiction and then arrive what is the 1/3 value? Now, 1/3 value you can do it, provided it's not ascertainable. But when it is ascertainable, why do you have to create a deeming fiction? this is in fact, a very well established principle in the Wipro Supreme Court decision in the customs law. Because in customs law, if you remember, in order to derive the assessable value on which the customs duty has to be calculated, it is CIF plus 1%. That is cost, insurance, freight plus 1%. If you see the 1% loading, when it comes to the insurance and freight, it is actuals, and only if the actuals is not ascertainable, there is a percentage which has been prescribed. But for the handling charges, it is 1% which has been prescribed by default. Why? When there is a direct handling cost which is ascertainable, why should one get into that 1%? This has been disputed in the Wipro case, and the Supreme Court has actually given a favorable decision in this regard. Now, citing that, even under GST law, also this Gujarat High Court judgment has been given, wherein it says that the mandatory fixed rate of deduction, that is 1/3 of the total consideration towards value of land, is ultra vires the provision as well as the scheme of GST. This is discriminatory, arbitrary, and violative of Article 14. Now, why? Here, what happens is this 7,000 rupees actually is attributable to land value. But by saying that it is only the 1/3 which is attributable towards land, and you are trying to charge 2/3 towards construction, what are you trying to do here? You are indirectly taxing the land, which otherwise the GST law itself does not have the power to levy tax on land. The GST law does not have power to levy tax on land. What is otherwise not taxable under GST cannot be indirectly taxed by way of creating a deeming fiction, right? Now, this is exactly what is the dispute, and the dispute has been settled in favor of the taxpayer. But there are two types of, there are two ways of looking at it, whether it is struck down or read down. Struck down meaning that entirely that, 1/3 itself is not to be applied, or it has to be read down only to specific cases. That also has been very clearly mentioned in this Gujarat High Court judgment, wherein they say that, see, this 1/3 deeming fiction, let it be there. I'm not saying it has to be only read down, because if it is not ascertainable, if the land value is not ascertainable, then you go for this 1/3. But if it is ascertainable, then you take the actual land value. See, this has been, specifically taken up in the case of a landowner's allotment. In fact, it's a very interesting case wherein it is the allottee who would have gone for the, writ petition after making the tax payment through the promoter to the government. And then the High Court would have directly sanctioned the refund to this person who has ultimately borne the incidence of tax under Section 54. Okay. Now, coming back, the refund also would have been sanctioned along with the interest at the rate of 6% also. Now, this is a very important judgment. But having said that, now can I go and apply this judgment in all my scenarios? Now, can I comfortably settle down because already in 2022 itself the judgment has come? No, it doesn't work that way, because this decision has been already appealed against in the Supreme Court. Currently, there is a special petition which is there against these judgment in the Supreme Court, and we are awaiting the final verdict from the Supreme Court. Now, pending this decision, as we stand today, it is a very highly litigative view for one to go by this judgment, because you never know how the Supreme Court judgment is going to be. The next important thing is time of supply. Time of supply, this is obviously in a construction, it is a continuous supply of services. For continuous supply of services, naturally, the contract period has to be more than 3 months. Then when the tax invoice has to be raised, whenever the payment is ascertainable, then invoice has to be issued when the payment is due. When the payment is not ascertainable, then invoice has to be raised as and when the payment is actually being received. The ascertainability has to be calculated based on the contract agreement. And if the invoice has to be, when the way in which the contract has been defined, the payment is linked with the completion of an event. Let us say you complete until this. Once the foundation has been made, once the first floor has been done, once the ground floor has been done. So like that, if there is a phased way, most likely it will be in a phased way. When the payment is linked with the completion of event, then the invoice has to be raised on or before the completion of that event. So I have some examples as to how it has to be calculated, but I'm not getting into it. The PPT will anyway be shared to the IDTC. These are examples, in fact, from the background material of IDTC only. Now, cessation of services, until then the invoice has to be raised. Some of the key disputes, I'm not getting into this dispute for want of time. And again, these are highly litigative. Can I go for 18% instead of applying 5%? For want of time, I'm not getting into these kind of disputes now. But definitely the PPT will contain, all the deliberations which we are making now. Now, over to the Q&A session. So can we start taking up the Q&A? I'm not going back to all the questions which have been already posted, because I believe most of the questions might have got answered during the course of our deliberation. So I would like to invite those questions which you think are not probably being addressed as part of this deliberation which we have made in this last 2 hours. Let me take a quick 1 minute of water break before that. So I'm actually, as I said before the, short break, I'll be taking up the questions which are very recent, so as to, avoid the duplication of issues which are already deliberated. Can I quickly take it for 5 minutes, Impri?
Ma'am, I think the time is short. Can we, if it's feasible, can we find out?
That's fine as well. Or, just to not, disappoint, let's take 2 or 3 questions alone quickly.
Okay, ma'am.
Is that okay? 1 or 2
Okay,
minutes. Okay. So the one question, how to compute the value of joint development rights in case of commercial projects having revenue sharing agreement? Okay. See, in fact, I had this, case of revenue sharing agreement. What happens in the revenue sharing agreement is that I believe what you're trying to say is that there is a revenue which is being shared between the landowner and the promoter rather than the allotments, right? So now what happens is that it's ideal that there is a joint developmental rights and there is a joint venture which these two are getting into. So I also have a slide in this regard. Let me share that. Revenue model between promoter and landowner. So it's ideally, it is better if the tax is paid by both of them, right? But having said that, there is also an option wherein the promoter is entirely responsible for the payment of the entire tax, and then the revenue is being shared between the two. Now, when there is a revenue sharing model, there may be a dispute as to what happens for the revenue that is being received by the owner's share. Now, when it comes to the landowner's share, it can always be disputed, and whenever there is a dispute, there are n number of decisions to support that when there is a revenue sharing model, it is nothing but there is no supply involved in it. It is as good as a partnership. So some of the decisions which I have cited here, the share of revenue which is received by the landlord will not be once again subject to GST because the entire transaction is already being subject to GST. And now coming to this particular revenue sharing, it is only like a partnership. It's only like a venture which has been made by two separate persons. Now, on these lines, it can be definitely litigated. But having said that, is it going to be a matter of litigation? Yes, quite naturally, it is possible that this could be a matter of litigation.
Can we find out now?
Yeah, I'll just take one or two questions alone. I think there are n number of questions. It's difficult for us to, okay, I think how to calculate promoter's liability if the TDR or FSI is purchased from the market in addition to agreement with landlord. I don't know what is purchased from the market. I cannot be. Assessee made a purchase of flat in a project from the landowner, which has not received OC. However, 15 units sold. Residents are occupying the projects on the date of purchase. Is GST not applicable? Yes, definitely GST not applicable for the ongoing, for the bookings which are going to come after the CC. After CC, there is obviously no GST at all. And then TDR script sold by landowner. Liable for RCM. See, TDR is definitely, liable for RCM. There is no question of to show in GSTR 1 of landowner. RCM, it never needs to be declared under GSTR 1. RCM has to be declared only in GSTR 3B. See, coming to this 1 and 3B, I already cautioned you how it has to be shown in 1 and 3B. One more thing that needs to be taken care is when it comes to real estate, 99C is very complicated because in 9C you have a list of transactions. Unbilled revenue at the opening, end, advances at the opening, advances at the end. But very importantly, there is one more, clause in this GSTR 9C, table 5, that talks about valuation. So whenever you have this 1/3 deduction towards value, that needs to be separately disclosed towards that valuation as well, though it is not under section 15. So I think with this, we'll come to the end of the session because we already exceeded 15 minutes of time. I'm really sorry that, many questions, we are not able to have a detailed deliberation on the Q&A. But I'm sure the session would have been useful and most of your questions would have already got resolved because I tried to take it slowly from the basics till whatever possible questions. Also, we tried to anticipate and we tried to cover it during the PPT itself, during the presentation itself. So over to the, administrative team.
Thank you, ma'am. Thanks for the wide, expanded deliberation, which has immensely increased our knowledge to the depth of this topic. Thank you.
Thank you. Thank you to IDTC for giving me this opportunity.
Thank you, ma'am. And thank you on behalf of my chairman and vice chairman as well, extend chair. Ashish ji, can we sign off for the day?